Modern stock speculation is dominated by the visual analysis of charts, replete with indicators, trend lines, and complex patterns. It is a common assumption that mastery of these tools is essential for success. Yet Jesse Livermore, one of the most successful speculators in history, found charts to be altogether too confusing. He relied not on visual aids, but on a direct interpretation of the market's raw data as it was printed on the ticker tape. His method was to perceive what can be called an invisible trend line, a line of least resistance established not by drawing on a graph, but by understanding the underlying forces of price, volume, and time. This is the method of reading momentum directly from its source. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The foundation of Jesse Livermore's method was a return to the first principle of market information, the ticker tape itself. While modern traders build their strategies around the retrospective images presented on charts, Livermore held a deep-seated skepticism towards them. He stated, "Personally, charts have never appealed to me. I think they are altogether too confusing." This was not the statement of a man who failed to understand them. It was the conclusion of a master who had found a more direct and truthful source. For him, the chart was a delayed, second-hand interpretation of events. The tape, in contrast, was the event itself, unfolding in real time. It was the best little friend he had, a direct line to the market's pulse. His entire career was a testament to the idea that all the information a speculator truly needs is contained in the simple, ceaseless flow of prices and volumes. He believed that the tape does not concern itself with the why and wherefore, it simply states what is. He did not ask the tape for reasons when he was 14, and he did not ask it when he was 40. The reason for a stock's movement might not be known for days or weeks, but the speculator's business is with the now, not the tomorrow. The tape provided that immediate truth. This focus on the tape led him to develop a unique perception of the market. He did not see stocks as entries on a balance sheet or as abstract corporate entities. He saw them as living things, with distinct personalities and habits. Stocks, like individuals, have character and personality, he wrote. Some are high-strung, nervous, and jumpy. Others are forthright, direct, logical. One comes to know and respect individual securities. This personification was not a poetic flourish. It was a practical method of analysis. It meant that a speculator could, through careful observation, learn the predictable behaviors of a stock under various conditions. This was the genesis of his dope sheets, which he carried not on paper but in his mind. He looked for stocks to run on form. He was not looking for tips or inside information. He was studying behavior. He understood that speculation is as old as the hills, and whatever happens in the stock market today has happened before and will happen again. His phenomenal memory for figures was not just a natural gift. It was a cultivated tool for recognizing these repeating patterns of behavior. He was not just seeing numbers, he was seeing the story of a battle between buyers and sellers, and the tape was his telescope. To understand how Livermore read the invisible trend line without charts, one must dissect his method into its three core components, the trinity of his tape-reading art: price action, volume, and the time element. The first and most fundamental of these was price action. Livermore's entire approach was built on the principle of trading in the direction of the prevailing momentum. This led him to a practice that is deeply counterintuitive for the average speculator. He always bought a rising stock and sold a falling one. He never bought a stock simply because it had experienced a significant decline from its previous high. He warned, never buy a stock because it has had a big decline from its previous high. The likelihood is that the decline is based on a very good reason. An amateur sees a stock that has fallen as cheap, but Livermore saw it as demonstrating weakness. He understood that the line of least resistance was downward, and fighting that momentum was a fool's errand. Conversely, he had no fear of buying a stock that was making a new high, a move that often paralyzes novice traders with fears of buying at the top. He stated, "In my method of trading, when I see by my records that an upward trend is in progress, I become a buyer as soon as a stock makes a new high on its movement, after having had a normal reaction." This was not about buying high. It was about buying right. A new high was the market's own confirmation that the forces of demand were overpowering supply, that the path of least resistance was upward. To buy at that moment was to align oneself with the dominant force. The price itself was secondary to the momentum it represented. Remember that stocks are never too high for you to begin buying or too low to begin selling. The focus was always on the direction of the movement, not the absolute price level. The invisible trend line for him was drawn by the succession of new highs in an uptrend or new lows in a downtrend. The second critical element of his analysis was volume. Price action alone was insufficient. It had to be validated by the force or lack thereof behind it. Volume was the measure of that force. A stock advancing into new high ground on heavy increasing volume was a sign of powerful, genuine demand. It was a confirmation that large interests were accumulating the stock and that the upward move had energy. Conversely, a price that drifted higher on light, anemic volume was a sign of weakness, a move that lacked conviction, and was likely to fail. However, Livermore's true mastery of volume analysis was most evident in his interpretation of reactions or pullbacks within a trend. He made a crucial distinction between what he called a normal reaction and an abnormal reaction. A normal reaction was a healthy and expected part of any sustained trend. In a bull market, a stock would advance for a period on high volume, and then it would inevitably pull back. Livermore taught that if this pullback occurred on much less volume than the preceding advance, it was a normal and constructive sign. It indicated that the selling was not aggressive, that holders of the stock were not rushing to unload. It was the market simply catching its breath, consolidating its gains before the next push higher. Never be afraid of the normal movement, he advised. An abnormal reaction, however, was a significant danger signal. This could manifest in several ways. It might be a sudden, sharp sell-off on a spike in volume, indicating that large holders were now aggressively distributing their stock. Or it could be a day of extreme volatility where a stock opens strong, makes a new high, and then reverses violently to close at or near its low for the day, all on heavy turnover. This told him that the character of the market had fundamentally changed. The balance of power had shifted from the buyers to the sellers. The invisible trend line was showing signs of breaking. Volume provided the context. It gave meaning to the price movements and was an indispensable tool for gauging the health and sustainability of a trend. The third and most subtle element, the one that Livermore himself claimed unlocked the true potential of his method, was the time element. It was not until I began to take into consideration the time element that my records really became useful in helping me to anticipate coming movements of importance, he wrote. My records began to talk to me. This was not about using a stopwatch to time minor fluctuations. It was about understanding the rhythm and tempo of a healthy trend. A strong, valid trend has a sense of urgency. It is impatient. It wants to continue its advance. He began to pay close attention to the duration of reactions. In a powerful uptrend, a stock might pull back for a day or two, but it should then quickly recover and push on to new highs. If, instead, a stock went stale after a reaction, if it moved sideways in a narrow range for an extended period without resuming its advance, it was a warning sign. It suggested that the buying power that had previously driven the stock higher was now exhausted. The momentum was fading. The time element was a test of the trend's vitality. He advised traders to familiarize yourself with a stock or different groups of stocks, and if you figure the time element correctly in conjunction with your records, sooner or later you will be able to determine when a major move is due. Time was the final arbiter. A stock that acted correctly in terms of price and volume but failed the test of time was a suspect. The invisible trend line was defined not just by direction and force, but also by persistence and rhythm. This intuitive method of synthesizing price, volume, and time to feel the market's true intention was Livermore's unique art. It was a skill honed over decades of intense, singular focus. While he developed this feel through instinct and observation, another market giant of his era, Richard Wyckoff, was independently working to codify these very same principles into a structured analytical science. Wyckoff's three fundamental laws, the law of supply and demand, the law of cause and effect, and the law of effort versus result, are in essence the scientific explanation for what Livermore was seeing on the tape. Wyckoff's analysis of price spreads, volume, and the time it takes for movements to occur provides a logical framework for reading the market's intentions. He taught traders to see the actions of large, informed operators, the composite man, through the patterns they left on the tape. If Livermore was the artist who could feel the pulse of the market, Wyckoff was the scientist who dissected its anatomy. For anyone looking to move beyond intuition and build a logical, repeatable methodology based on these timeless principles, the Richard Wyckoff Trading Methods channel is an essential resource. It provides a systematic education in reading the tape with the same depth and clarity as the masters. You can find a link in the description. In the end, Livermore's approach was a holistic one. He did not rely on a single indicator or a rigid pattern. He was in a constant state of diagnosis, observing the market's behavior through the lenses of price, volume, and time. He was not looking at a static picture on a chart. He was engaged in a dynamic conversation with the tape. He listened for its confirmations, heeded its warnings, and respected its final authority. He was not trying to impose his will on the market, but to understand its will and align himself with it. This was how he perceived the invisible trend line. It was not a line drawn on a chart, but a force felt in the heart of the market. A force he learned to read with unparalleled mastery. Recognizing the behavior of the market through the trinity of price, volume, and time was the foundational skill that separated Jesse Livermore from the ordinary trader. However, possessing the ability to read the language of the tape is one thing. Knowing how to use that language to formulate a coherent and profitable trading campaign is another entirely. The next stage of his evolution was the development of a strategic framework for a single purpose: to identify and capture the heart of the great market movements. This strategy was not based on prediction or forecasting. It was built upon a single, powerful principle that governed his every action: the concept of the line of least resistance. He stated, "Prices, like everything else, move along the line of least resistance. They will do whatever comes easiest." The entire object of his analysis was to determine this path. His task was not to guess where the path would lead, but to wait patiently until the path defined itself, and then to follow it with conviction. This concept is fundamental. The line of least resistance is not a mystical force. It is the simple expression of the imbalance between supply and demand. When buying pressure is stronger than selling pressure, the line of least resistance is upward. When selling is stronger than buying, the line is downward. When the two forces are in equilibrium, the market moves sideways in a narrow range. The amateur trader exhausts his capital and his mental energy fighting these forces, buying into declines and selling into advances. The master speculator waits until the battle between buyers and sellers resolves itself. He waits for the market to declare its intention. The thing to do, Livermore advised, is to watch the market, read the tape to determine the limits of the get-nowhere prices, and make up your mind that you will not take an interest until the price breaks through the limit in either direction. That breakout was the signal that the line of least resistance had been established. That was his signal to get busy. To identify this critical moment, he developed and relied upon a set of specific practical tools. His first tool was the analysis of group behavior. Livermore observed a simple but profound market truth. Stocks do not move in a vacuum. They move in groups, sectors, and industries. We know that all stocks do not move one way together, he noted, but that all the stocks of a group will move up in a bull market and down in a bear market. This led to a critical trading principle: follow the leaders. He always confined his studies to the prominent active stocks of the day, understanding that if you cannot make money out of the leading active issues, you are not going to make money out of the stock market as a whole. When a true bull market was underway, the leading stocks in the leading groups would be the first to advance, and their movements would be the most powerful. This observation gave him an invaluable diagnostic tool for identifying weakness. The common practice among the public and many so-called professionals is to look for the laggards in a strong group. The reasoning seems logical. If the leading motor stocks have advanced 20 points, the one motor stock that has not moved must be cheap and is due for a rise. Livermore saw this as a fatal error. He wrote, "Experiences had taught me to beware of buying a stock that refuses to follow the group leader. A stock that remains dormant while its peers are advancing is not a bargain. It is a patient demonstrating a severe underlying illness. Its failure to respond to the bullish news affecting its entire industry is a clear signal that there is something profoundly wrong with it. When the men who ought to want a stock do not want it, why should I want it?" he reasoned. The absence of inside buying, or worse, the presence of disguised inside selling, was the only explanation. The invisible trend line for that stock was not upward, and no amount of hope could change that fact. The tape plainly told him there was something wrong, and that was all the information he needed to stay away, or even to sell the stock short. His second, and perhaps most famous tool for identifying the start of a major move was the pivotal point. This was the specific price level that acted as his ultimate timing signal. He wrote, "Whenever I have had the patience to wait for the market to arrive at what I call a pivotal point before I started to trade, I have always made money in my operations." He stated this was because he commenced his play at the exact psychological time, at the very beginning of a move. A pivotal point was a level where, if crossed, the line of least resistance would be undeniably established. He identified several types of these points through his meticulous record-keeping. The most straightforward were the major price barriers: 50, 100, 200, and 300. He observed that a fast and straight movement almost invariably occurred after such points were passed. These levels acted as psychological dams. Once breached, the pent-up market energy was released in a powerful surge. Another critical type of pivotal point was the breaking of a new high for a movement, or a new all-time high. Let us say that a new stock has been listed in the last 2 or 3 years and its high was 20, he explained. If something favorable happens in connection with the company and the stock starts upward, usually it is a safe play to buy the minute it touches a brand new high. For Livermore, this was the moment of least resistance. All the sellers who had been trapped at lower prices were out, and the stock was entering clear territory. But a pivotal point was not a blind signal to buy. The character of the action after the point was crossed was the final confirmation. The advance had to be immediate and forceful. As he demonstrated with Anaconda, when the stock crossed 300 but failed to continue its advance with vitality, it plainly was flashing the danger signal. The action of the stock right above 300 clearly showed it had become a dangerous stock to own. The pivotal point gave him the entry, but the subsequent action of the tape confirmed whether he should stay in. It was a 2-part test that required both patience to wait for the signal and alertness to interpret the follow-through. The third tool in his arsenal was the method of market testing, which was inextricably linked to his principle of pyramiding. Once a pivotal point was crossed and he decided to act, he never took his entire position at once. This, he believed, was a wrong and dangerous practice. Instead, he would initiate a small exploratory trade. Let us suppose that you want to buy 500 shares of a stock. Start by buying 100 shares, he instructed. This initial trade was a probe, a question asked of the market. The market's answer came in the form of an immediate profit or loss. He stated as one of his primary rules. It is foolhardy to make a second trade if your first trade shows you a loss. Never average losses. If his first purchase showed a loss, it meant his timing was wrong, and the only sensible action was to close the trade and take the small loss. If, however, the first trade showed an immediate profit, it was the market's confirmation that his timing was correct and that he was aligned with the line of least resistance. Only then would he make his second commitment. Crucially, he insisted that each succeeding purchase must be at a higher price than the previous one. This practice of buying on a scale up is one of his most important but widely ignored principles. It served as a continuous validation of his position. The fact that his trades consistently showed him a profit was his proof that he was right. This method ensures that a speculator's largest positions are held only when the market is strongly confirming his judgment. It keeps him out of trouble when his initial timing is off and forces him to be most aggressive when he is most correct. It is the scientific application of the old trading axiom, cut your losses short and let your profits run. These three tools, analyzing group behavior, identifying pivotal points, and testing the market with pyramiding trades, formed the mechanical basis of Livermore's strategy for capturing the big swing. But underpinning all of them was his core philosophy. The speculator must be a servant to the market, not its master. He must react to the market's evidence, not try to impose his own predictions upon it. He stated, "A man may form an opinion regarding a certain stock and eventually be correct in his opinion, but will lose money by acting on his opinion too soon." The market itself is the final arbiter. He learned to banish wishful thinking and to respect the message of the tape above all else. His own opinions were worthless until validated by the market's action. Markets are never wrong, opinions often are, was the foundational truth upon which he built his fortune. His system was not a method for predicting the future. It was a method for recognizing the present with unflinching clarity. He waited for the invisible trend line to reveal itself, and only then, with the full force of the market's momentum behind him, did he act. The mastery of the principles of momentum and the precise identification of the line of least resistance constitute the mechanical framework for successful speculation. A trader can possess a perfect understanding of group behavior, pinpoint pivotal points with unerring accuracy, and execute his market tests flawlessly. Yet with all this technical knowledge, he can still fail. The reason is that the most formidable opponent a speculator ever faces is not the market itself, but his own human nature. The final and most difficult lesson in the art of speculation is the conquest of emotion. Jesse Livermore learned through years of painful and costly experience that the ultimate battle is waged not on the ticker tape, but within the confines of the speculator's own mind. The development of psychological discipline is the final and most crucial step in holding the invisible trend line. The central problem for every trader is the constant internal war between two powerful and primal emotions, hope and fear. In everyday life, these emotions serve essential purposes, but in the world of speculation, they become the speculator's deadliest enemies. The tragic irony, as Livermore observed, is that the average man applies these emotions in the exact reverse of how they should be used in the market. When a trade goes against him, he is filled with hope. He buys a stock at a certain price and it begins to decline. Instead of recognizing that his initial judgment was flawed, he hopes that the decline is temporary. He hopes for a rally that will bring the price back to his entry point so he can escape without a loss. This hope is a form of financial anesthetic. It numbs him to the pain of his mistake and keeps him anchored to a losing position as it deteriorates. Livermore learned to reverse this instinct. When a trade went against him, he did not hope. He felt a sharp, immediate fear. He feared that the small loss he was facing could quickly metastasize into a much larger, capital-destroying one. This fear was not a paralyzing emotion. It was a call to action. It was the signal to close the trade, accept the small loss, and preserve his capital for a more sound opportunity. Conversely, when a trade moves in a speculator's favor, he is consumed by fear. He has a small, fragile profit, and he is terrified that the next market fluctuation will take it away from him. This fear compels him to sell too soon, to snatch a meager profit and abandon a position that may have been the start of a major fortune-building move. He is afraid of losing what he has just gained. Livermore understood that this was the moment for hope. A profit, however small, was the market's own confirmation that his initial judgment was correct. It was the evidence that he was aligned with the line of least resistance. This was the time to be courageous, to have faith in his analysis, and to hope that his small profit would grow into a very large one. This deliberate and conscious reversal of his natural emotional responses, fearing his losses and being hopeful about his profits, was the psychological key that unlocked his ability to ride the great market swings. It was, he confessed, one of the hardest things to learn, but it was the only way to make the truly big money. This psychological discipline found its ultimate expression in his most famous principle, sitting tight. After spending years in Wall Street and after making and losing millions of dollars, he came to a profound conclusion. It never was my thinking that made the big money for me. It always was my sitting. Got that? My sitting tight. This is one of the most misunderstood concepts in speculation. Sitting tight is not a passive act of laziness or inattention. It is an act of profound, disciplined patience. It is the ability to hold a correct position through all the minor, nerve-wracking fluctuations until the fundamental reasons for the position have changed. He observed countless traders who were correct on the market at exactly the right time. They would buy at the very beginning of a bull market or sell at the start of a bear market. Yet they made no real money. The reason was simple. They could not sit tight. They would be shaken out by a small reaction or tempted to take a quick profit, thereby losing their position and missing the heart of the major move. Men who can both be right and sit tight are uncommon. To achieve this level of fortitude, Livermore had to learn to differentiate between the market's meaningful signals and its random noise. He understood that no market moves in a straight line. Even the most powerful trend is punctuated by counter-movements. His analysis of price and volume gave him the tool to distinguish between a normal reaction and a genuine change in trend. A normal reaction, as he defined it, was a pullback on diminished volume. It was the healthy, expected rhythm of a market in motion. He learned to endure these reactions without being shaken. His initial analysis, confirmed by the market's action at the pivotal point, was his anchor. As long as the stock's behavior remained consistent with that of a healthy trend, he would not be swayed by these temporary dips. He had a backlog of profit from his pyramiding strategy, which provided a psychological buffer. This allowed him to view these reactions not as threats, but as a normal part of the process. This discipline was built on another core rule: do not argue with the tape. While he learned to ignore the noise of normal reactions, he also trained himself to act instantly and without hesitation when the tape sent a clear signal that the invisible trend line was changing direction. This signal often came in the form of an abnormal reaction, a sharp break on heavy volume, a failure to rally after a decline, or a stock's refusal to follow its group. When he saw these signs, he did not wait for confirmation from newspapers or seek opinions from others. The tape had spoken, and its verdict was final. The reasons could wait, but the action could not. This immediate response was the other side of the sitting tight coin. His patience in a winning trade was matched only by his impatience with a losing one, or one that was beginning to turn against him. He knew that the moment he began to argue with the tape, the moment he started to substitute his own hopes for the market's clear evidence, he was lost. The ability to read the invisible trend line, therefore, was not merely a technical skill. It was a holistic discipline, a synthesis of acute market observation and profound self-control. It was the understanding that the market is a reflection of human psychology, and to master the market, one must first master oneself. This journey from a boy in a bucket shop to a Wall Street legend, this evolution from a gambler to a master speculator, is a story of intellectual and psychological struggle. It is a story that every person who seeks to profit from the markets must understand, not just as a history lesson, but as a practical guide. There is no more powerful or intimate account of this journey than the one captured by Edwin Lefebvre in his timeless classic, Reminiscences of a Stock Operator. The book is more than a biography. It is a masterclass in the mind of a trader. It allows you to stand beside Livermore, to witness his thought process, to feel his internal battles, and to learn his hard-won lessons without paying the multi-million-dollar price he did. It is a guide to developing that sixth sense for the market. However, to translate the profound wisdom of a book written a century ago into an actionable edge in today's complex, high-speed markets requires a key. That key is the detailed chapter-by-chapter analysis by Max Davidson. It is not a simple summary. It is a deep analytical dissection of the strategies, the psychology, and the timeless principles that made Livermore a titan. It deciphers his methods, illuminates his psychological insights, and forges them into a practical framework for the modern trader. For anyone serious about moving beyond the surface and truly understanding the art of speculation, the link in the description is your next step.